President Trump is trying to seize personal control of the Fed in an attempt to escape accountability for his own economic failures, and Senate Republicans are facilitating it. Donald Trump promised to lower costs on day one, but costs are up. He promised a golden age for American workers. Instead, he's wrecked the job market. Donald Trump has the ability to stem the bleeding, but rather than change his tariff policies, reverse his disastrous energy policies, and restore the health care coverage that he has just ripped away from 15 million Americans, Trump wants to make the Fed his economic scapegoat. Dr. Myron's nomination is just the next phase of President Trump's very public, months-long campaign to stack the Fed with loyalists. When Trump seizes control, Fed decisions won't be driven by data, but by Donald Trump's personal feelings. And when the Fed loses credibility, businesses and consumers stop trusting it to control inflation and prices go up. It happened when President Nixon bullied the Fed and forced prices up for a decade. And it's happened overseas when dictators have seized control of their central banks. Dr. Myron has already spectacularly failed every independence test that we could think of. He could not say the words, Donald Trump lost the 2020 election. Dr. Myron will be the first admitted election denier to sit on the federal board. He is refusing to resign his current White House job. That is ridiculous. One day of serving as the president's chief economist and supposedly independent governor at the Fed would be one day too many. And let's be 100% clear, we are not voting on a 4-month term at the Fed. Dr. Myron has also indicated he could sit in that seat indefinitely after his term expires in January of next year. Dr. Myron's so-called leave of absence is a bad joke. He will be sitting down the street from the White House, and he has refused to disclose any of the communications he has with the president or the White House while he's at the Fed. This nomination sets up an obvious Trump loyalty test for Dr. Myron. He knows that every vote he takes determines whether he can go back to his White House job. That is not independence. That is servitude. He will have zero credibility with markets, zero credibility with businesses, and zero credibility with the public if he is confirmed to the board under these circumstances. This nomination is a Trump loyalty test for Republican senators, too. Every senator who spoke at Dr. Myron's confirmation hearing said they supported Fed independence. If it's true that you believe in independence, then you should vote no. And I know it's not easy. It wasn't easy for me when I voted against President Biden's choice to run the Fed. But we were not sent here to serve the president. We were sent here to serve the people of our states. And if we refuse to do that today, we are sentencing those same constituents to years of potentially higher prices and higher unemployment. Thank you, Mr. Chairman.
Thank you, Ranking Member. Dr. Myron brings deep experience, proven leadership, and a clear commitment to ensuring that the American economy remains strong and competitive. He has also guided policies that strengthen domestic production, reduce trade imbalances, and bolster economic resilience. The work of Dr. Myron directly affects the lives of everyday Americans and the prosperity of states like my home state of South Carolina, where hundreds of thousands of small businesses rely on policies that foster growth, investment, and opportunity. Dr. Myron is ready to step into this role that is critical to advancing opportunity, promoting accountability, and protecting American prosperity. I look forward to confirming Dr. Myron and the contribution he will make in his service to our nation. We will now vote on the nomination of Stephen Myron to be Governor, Board of Governors of the Federal Reserve. The clerk will call the roll.
The chairman?
Aye.
Mr. Crapo?
Aye.
Mr. Rounds?
Aye.
Mr. Tillis?
Aye.
Mr. Kennedy?
Aye.
Mr. Haggerty,
Aye.
Ms. Lummis, Mrs. Britt, Mr. Ricketts,
Aye.
Mr. Banks, Mr. Kramer, Mr. Moreno,
Aye.
Mr. McCormick,
Aye.
Ms. Warren,
No.
Mr. Reed, Mr. Warner, Mr. Van Hollen,
Nay by proxy.
Ms. Cortez Masto,
Nay by proxy.
Ms. Smith,
No.
Mr. Warnock,
No.
Mr. Kim,
No.
Mr. Gallego, Ms. Blunt Rochester,
Nay by proxy.
Ms. Alsobrooks.
Nay by proxy.
I have 13 ayes, 11 nays.
The ayes have it. The nomination is hereby ordered, reported favorably to the full Senate. We did say that we would allow Senator Reed to have 2 minutes, and then what we'll do after that is I'll adjourn the executive session. We'll bring in the witnesses for the deposit hearing, and then 2 or 3 minutes later, we'll start the deposit hearing. Senator Reed, you
Thank you, Mr. Chairman, for your kindness in this respect. I just want to make the point, the vote is over, but Mr. Mirren indicated that he could hold the dual position of the Council of Economic Advisors and the Federal Reserve Governor because of a legal opinion he received. We requested in writing that legal opinion, and he's refused to give it to us. So we are still completely uncertain as to his legal status and his independence, which is critical, as a member of the Federal Reserve Board. And as we go forward and go towards the floor, this issue of his legal ability to retain both jobs will be pressed further, and I would urge Mr. Mirren or his associates to deliver to us the opinion of counsel so we can look at it. Thank you, Mr. Chairman, very much.
Yes, sir. Thank you. This executive session is now adjourned. We'll start our hearing in about 2 minutes. Thank you all. Good morning. Thank you all for joining us today. I want to thank our witnesses for appearing before the committee today. Your perspectives are critical as we examine the future of deposit insurance and the stability of our financial system. Deposit insurance is central to the trust and confidence Americans place in their banks. And since its creation in the 1930s, no insured depositor has ever lost a single penny. In fact, over 99% of all deposit accounts are fully insured under the FDIC. That is why, whether folks in South Carolina are walking into a mid-sized bank like United Community or a credit union like Carolina Foothills, they know that when they see that FDIC insured or NCUA insured sign, their money is safe. That confidence is not just a promise on paper, it's a peace of mind for hardworking families and small businesses. That record of protection is a cornerstone of our economy and the reason deposit insurance is often described as the bedrock of our financial stability. But recent events have thrust deposit insurance into the limelight and raised the question of whether it is time to rethink the current deposit insurance system. When Silicon Valley Bank and others failed in 2023, deposit insurance played a key role in stabilizing our economy and making sure account holders were safe. The government had to take extraordinary steps to cover unprecedented amount of uninsured deposits, and there was a flight to safety as uninsured deposits moved toward the largest institutions in banking. Those actions underscore both the importance of deposit insurance and the need to carefully evaluate reforms. But as I have learned in the past and said as well, reform is not simple. It comes with trade-offs. Expanding deposit insurance, for example, may provide more security for some small businesses, but if it's not calibrated properly, it comes at a cost to banks, small businesses, and everyday Americans. The committee must weigh these trade-offs carefully with an eye toward what truly strengthens our financial system rather than what simply sounds appealing in the moment. That is why I have been clear. Deposit insurance reform should not be based on rushed decisions. We are here to build the best policy to protect the American people, promote responsible banking, and maintain confidence and diversity in our financial system, from the smallest community banks to the largest institutions. I'm eager to hear from our witnesses today. Your insights, each and every one of you, your insights will help guide this committee as we weigh potential paths forward. Thank you again for being here, and I look forward to this discussion. Ranking Member Warren.
Thank you, Mr. Chairman, and thank you for holding this hearing today. It really is important. During the Great Depression, millions of Americans lost their life savings as thousands of banks failed. And our country learned the hard way that it is critical for the health of the economy for people to have a completely safe space to store their money. I grew up in Oklahoma, decades after the Great Depression, but I grew up in the shadow of always hearing the stories about who had lost money, who'd been wiped out, and what it meant to show up at your bank and the money that had been carefully saved had just disappeared. In 1933, Congress created the Federal Deposit Insurance Framework. And as the chairman said, depositors have not lost a penny of their insured deposits in the 92 years since then. FDIC and NCUA insurance is currently limited to $250,000. Above that, if a bank or credit union fails, customers with bigger deposits may have to wait in line and hope that they will be able to recover some portion of their funds. Now, small and mid-sized businesses need a safe place to store money for payroll, operating expenses, and everyday payments. They often maintain balances above $250,000 in their transaction accounts. Several recent bank failures have made clear that the deposit insurance framework could be strengthened to better serve small businesses and to level the playing field between banks on Wall Street and smaller banks that serve Main Street. Take a look at what happened in March of 2023. Silicon Valley Bank and Signature Bank blew up, creating the third and fourth largest bank failures in American history. In order to protect from additional bank runs and stop a full-blown financial crisis, the Fed, FDIC, and Treasury took the extraordinary step of guaranteeing all uninsured deposits at those banks. The government backstopped literally billions of dollars in deposits for massive corporations like the venture capital firm Sequoia, crypto company Circle, and electronics company Roku. And those companies did not lose a penny. Compare that with two small bank failures in Oklahoma and Texas in the years after SVB crashed, and the story turns out to be very different. Local small businesses like pharmacies and grocery stores and construction companies that kept cash at those community banks got $250,000 in FDIC coverage and collectively lost millions of dollars on the uninsured balance. I don't think we want or expect small businesses to comb through community bank call reports every quarter to see if it's safe to keep your transaction account there. I don't think they should be required to make an investigation to see if there might be executive fraud at the bank when deciding where to have a checking account. The last thing a small-time dentist or landscaping company or a bakery should have to worry about is losing money because their local bank failed. People understand which banks will and won't get bailed out if there's trouble. In the week following SVB's crash, $100 billion in deposits left the little banks, while the largest 25 banks saw $120 billion in new deposits. Drawing deposits out of smaller banks diverts funds away from local lending to families and small businesses and pushes it toward Wall Street speculation. And the small businesses without access to a mega bank, especially in rural communities, have no choice but to suffer the consequences if their local bank or credit union fails. Now, I've long pushed for leveling the playing field by increasing deposit insurance limits for business transaction accounts. Covering these accounts would reduce the likelihood of runs, help smaller financial institutions compete, and ensure small businesses have a completely safe place to store their cash. If small and mid-sized businesses are protected, this could also limit the government's impulse to backstop giant depositors when a crisis occurs. As the committee considers this legislation, there are a couple of principles I hope we will stick with. First, the deposit insurance limit for banks and credit unions should be raised to a level that covers the cash needs of small and medium-sized businesses, businesses that do not have the capacity to execute sophisticated cash management strategies deployed by massive corporations. Second, the increased limit should apply to transaction accounts, accounts that are used to make and receive payments. The account should not pay interest or other monetary rewards. And finally, the policy should be simple. Complex rulemaking, opt-in and opt-out features, convoluted definitions would create unnecessary compliance costs, customer confusion, and invite regulatory arbitrage. A clear and simple framework will be easier for the FDIC and NCUA to administer for small businesses, easier for small businesses to understand, and easier for banks to implement. This is a common sense policy with broad bipartisan support. It's good for small banks and credit unions. It's good for small businesses, and it's good for our economy. Thank you, Mr. Chairman.
Yes, ma'am. Our first witness is Mr. Kenneth Kelly, Chairman and CEO of First Independence Bank. Mr. Kelly, you are now recognized for 5 minutes.
Thank you, Chairman Scott, Ranking Member Warren, and members of the committee. Thank you for the opportunity to testify at today's hearing. I am Kenneth Kelly, Chairman and CEO of Detroit-based First Independence Bank, a minority depository institution with nearly $700 million in assets. First Independence opened in 1970, and we have proudly served customers in the Detroit area for more than 55 years. And more recently, we opened 2 branches in Minneapolis. In addition to my role at the bank, I also serve as chair-elect of the American Bankers Association, and I am testifying today on behalf of the ABA. Deposit insurance has been a cornerstone of the U.S. banking system for nearly a century and protects customers and strengthens communities and enhances the stability of the banks that fund it. Despite its success, the deposit insurance system has faced challenges in recent years. The 2023 failures of Silicon Valley Bank and Signature Bank and a more recent failure of a community bank in Oklahoma raised questions about whether the system could be better prepared to handle the realities of modern banking. Since the failure of SVB, the ABA has actively solicited input from members on the potential changes that could bolster public confidence in the system. In 2023, ABA formed a working group of more than 300 banks of all sizes to discuss possible reforms. Those discussions revealed a simple truth. Every option, including maintaining the current system, involves trade-offs that must be acknowledged. In January, I was asked to lead an ABA task force on deposit insurance modernization representing a cross-section of the industry. Our recommendations, which are approved unanimously by the ABA board in July, include changes only Congress can make and some actions the FDIC can take under its current authority. Here's a summary of the 10 recommendations divided into 3 broad categories. The first being emergency action and authority, the second being deposit insurance coverage, and then third, bank resolution. Recommendation 1, to limit the risk of contagion, Congress should grant the FDIC preemptive approval to temporarily back deposits and/or liabilities under a specified set of crisis conditions as it did during the pandemic. Item 2, to improve transparency, Congress should require the FDIC to outline the specific considerations that warrant a systemic risk determination, as well as the methodology used to calculate any special assessments on banks after a failure. Recommendation 3, while some depositors may benefit from additional deposit insurance coverage, ABA does not believe that there is currently enough public data to recommend a specific increase in the coverage limit or fully understand the cost of any change. Accordingly, the FDIC should expand its efforts to collect the data needed to help banks and policymakers understand the trade-offs between those options. Once a limit is established, it should be indexed to inflation. 4, Congress and the FDIC should reassess the size and structure of the deposit insurance fund, but also continue to use a risk-based approach when setting assessments. 5, Congress should make deposit insurance assessments tax deductible as they were prior to 2018. Number 6, the FDIC should evaluate the costs and benefits of allowing banks to purchase targeted excess deposit insurance. Number 7, Congress should authorize the FDIC to broaden the least cost test when considering how to resolve failed banks. Number 8, Congress should also authorize the FDIC to consider the cost of resolutions on communities and provide the FDIC with the power to balance the least cost test for community bank failures. Number 9, to enhance fairness, the FDIC should open resolution-associated asset auctions to a more diverse group of investors. Number 10, the FDIC should publicly release the resolution approaches it considers and estimated costs of each failure. In conclusion, my task force colleagues and I believe these recommendations will make the system better, fairer, and more resilient at times of stress. And for that reason, we encourage Congress and other policymakers to give them careful consideration. Thank you again for the opportunity to testify, and I look forward to your questions.
Thank you, sir. Ranking Member Warren, I believe that you and I will have to hold a hearing at the next Gentleman's Bank in Hawaii.
Oh, I'm ready.
second the motion.
Next, Mr. Bob Harrison, Chairman, President, CEO of First Hawaiian Bank.
Chairman Scott, Ranking Member Warren, members of the committee, thank you for the opportunity to testify today on behalf of the Mid-Sized Bank Coalition of America. I'm Bob Harrison, Chairman, President, CEO of First Hawaiian Bank. Today, I'm representing the voice of over 100 mid-sized banks across the country who are members of our coalition. Mid-sized banks are the critical middle of American banking. We finance growth for small, medium-sized businesses that drive local job creation. We support essential infrastructure, housing developments, schools, and hospitals. We keep deposits circulating locally, turning savings into loans for businesses and families. We serve places other banks won't, from outer islands to rural counties, where our commitment is longstanding and personal. Mid-sized banks are close enough to the communities to understand their needs, strong enough to deliver, and vital to the prosperity of Main Street. That means we are lenders to small manufacturers in Ohio, family farms in Nebraska, and energy businesses in Louisiana. It means that in Hawaii, where my bank has been serving customers since 1858, we're financing homes, schools, businesses across all the islands, as well as Guam and Saipan, places where the largest banks have withdrawn from. Mid-sized banks take deposits from our neighbors, put them to work locally. On average, we lend out 76 cents of every deposit dollar we hold. By contrast, the largest banks lend out 54 cents of every dollar. So when deposits migrate to the biggest institutions, credit to local businesses and communities shrinks. The stakes for Main Street are very real. In 95% of U.S. counties, regional and community banks provide the majority of small business credit. That's why I want to thank Senator Hagerty and Senator Alsobrooks for their leadership in introducing bipartisan legislation to modernize deposit insurance. The turmoil of March 2023 showed us just how urgent this issue has become. In days, 3 of the 4 largest bank failures in U.S. history occurred because of lightning fast runs on uninsured deposits. Those deposits did not leave the banking system. They left mid-sized and community banks for the perceived safety of the very largest institutions. Depositors moved to the GSIBs because they assumed those deposits were implicitly guaranteed. That implicit guarantee is the moral hazard. If we do nothing, we are reinforcing it. The solution is targeted, narrow, and paid for by the banks. Expand FDIC coverage for business operating accounts, that's payroll and working capital. It's not a blanket guarantee for all deposits. It's a specific fix to the problem that triggered the 2023 runs. Modernizing deposit insurance matters. It prevents runs before they start. Banks shouldn't have to scatter payroll accounts across dozens of other banks just to feel safe. It's industry funded. Banks, not taxpayers, will bear the cost, phased in over 10 years. To replace this funding in the wholesale markets would cost 3 to 5 times more than any potential additional FDIC premiums. The additional FDIC premium should be with the concept of everybody benefits, everybody contributes. The largest institutions contributing more, given the markets assume they have full coverage. Lastly, it restores balance and competition. Today, depositors assume large bank balances are guaranteed when others are not. I know there are questions about alternatives reform. You may ask, why not just TAG? Because TAG is temporary and only kicks in after there is panic. Why not private sweep networks? Because they're costly, confusing, and fragile. If we rely on private sweep networks as the solution, those networks could become systemically important. Businesses and families should be free to bank with the institution that knows them and shares their values. The mid-sized bank model is built on relationships, and our success is tied to the success of the communities we serve. By enacting targeted deposit insurance reform, Congress can protect jobs and paychecks while also preserving choice and competition. That will ensure that America's banking system, from Main Street to Wall Street, remains strong to serve our economy. Thank you for holding the hearing today. I look forward to your questions.
Thank you, sir. Next, we'll hear from Mr. Nicholas Patsiadli.
Thank you, Chairman Scott and Ranking Member Warren and members of the committee. I appreciate the opportunity to testify today on deposit insurance reform. My testimony today is my own. I am speaking today solely in my capacity and not behalf of any client or the firm that I represent. As the former general counsel of the FDIC, I speak to bring perspective to the policies that have been brought forward to expand deposit insurance coverage in the current state of deposit insurance following the multiple bank failures in 2023. I welcome the opportunity to discuss the proposals and to expand deposit insurance to cover any of the operational accounts that are necessary for these operational accounts. With regard to background, Congress has long supported deposit insurance dating back to 1933. I will belabor the point and not go through the history of the expansion of each of the increases. However, the most recent increase in deposit insurance was in the 2008 crisis, raising the deposit insurance threshold from $100,000 to $250,000. That is the last time that Congress has addressed this topic without addressing operational accounts or without figuring out what should be done with regard to expanding deposit insurance. I will say that the Dodd-Frank Act did make permanent the $250,000 limit, which was obviously enacted, and it changed the method of calculating the deposit insurance assessments due to increasing the average institution's consolidated asset limit minus average tangible equity. So it's a very complicated formula, and it is not something that is easily understood, but at the same time, those increased assessments are real and they do have an impact on the industry as a whole from what they can lend from the perspective of operational capital. Moving forward, looking at the most recent failures of 2023, obviously those are the most unique to what had happened in the last view of deposit insurance when SVB, Signature, and First Republic all sort of went under at the same time. You had a notion of the systemic risk exception applied by the FDIC, which essentially meant that deposit insurance limits went out the window. Those changes when you had the systemic risk exception create a different playing field from the notion of how bank failures are looked at going forward. It is also one of the reasons that the least cost test was evaded when some of these institutions were sold to other institutions, meaning that instead of smaller regional institutions potentially acquiring those assets, they were given to the largest of bank companies. That is something that should be reviewed as a policy perspective from this committee. Despite those extraordinary measures, Congress has not raised the $250,000 threshold for deposit insurance. The expanded coverage was temporary and applied only to those that had the systemic risk exception. With regard to those failures, while not high, 68% of First Republic deposits were uninsured. That is something that should be considered by the committee is a notion of how do we look at operational accounts going forward from the perspective of those that are to be insured. Estimated losses from the three marginal banks were about $35.2 billion as of September 2023. Special assessment covered the largest institutions, those above $100 billion, and that comprised about $16.3 billion in new assessments for those going forward. And really, the question is, how should those costs be distributed across all of the banks? Is it a shared mutual experience, or is it a too big to fail type experience? Notably, the FDIC in 2023 proposed three different possibilities for reform. Number one was limited coverage, maintaining essentially what is the current balance of $250. Two, unlimited coverage, provide essentially a systemic risk exception for everything across the board. And three, targeted coverage. How do you pick and choose which type of accounts, particularly operational accounts as opposed to large depository accounts? Those three proposals have not been addressed by Congress and should be considered for purposes of this hearing. With regard to the final analysis of where the FDIC is on these issues, there are emphasis on readiness among the living wills and the plans of the banks. Those are necessary topics to discuss, and I look forward to any questions you have on those issues. Thank you.
Thank you. Finally, we'll hear from Mr. Peter Rice, President and CEO of Hanscom Federal Credit Union.
Chair, Ranking Member, and members of the committee, thank you for the opportunity to testify. Today, while you hear one singular voice, I speak for the 144 million credit union members, families who depend on every paycheck, and small businesses that keep Main Street alive. I also speak for 40 million Americans in the Defense Credit Union Council, Americans who serve or have served our nation in uniform, and the loved ones who spent their time supporting that service alongside them. While credit unions remained safe during the March 2023 crisis, we are deeply concerned about the risks posed by implicit guarantees for too big to fail banks and the threat this creates for Main Street and our national security. When their payroll is at risk, America's stability is at risk. When their local banks are weakened, Main Street is weakened. And when small businesses stumble to corporate greed, our national security stumbles also. This is bigger than banking. This is about paychecks, communities, and the strength of our nation. Our fellow Americans are counting on us. Now, I realize that in financial policy, we often find ourselves trying to choose either end of the sharp stick between the dangers of moral hazard on one side and the need to buffer confidence on the other. But this is no longer just a question of moral hazard. It's a question of national hazard. This is America, and we can grab that and balance that stick in the middle. In March 2023, our nation saw the fastest bank runs in modern history. SVB lost a quarter of its deposits in a single day. Depositors moved roughly $119 billion out of small banks in 1 week, double the previous record, while the largest institutions saw inflows. Per JP Morgan's own analysis, $550 billion moved to big banks and money funds during the crisis. This wasn't about better interest rates. It was about confidence. Americans believed that the biggest banks were safer. Multiple studies from the IMF to academic research at NYU confirmed that deposits fled smaller institutions, even when larger banks were not offering higher rates of return. If left unaddressed, this dynamic entrenches too big to fail and hollows out relationship banking in our communities. Small businesses are the backbone of America. They represent 99.9% of firms, 59 million jobs, employing nearly half the private workforce, 43.5% of our GDP, and they are key innovators, producing patents at a rate 16 times than larger institutions. 2/3 of small businesses rely on local or regional institutions where they are known and their market is understood. When confidence drives them to move their deposits to Wall Street, communities lose credit, payrolls become unstable, and our defense supply chain grows brittle. We've already seen the cost. In Lindsay, Oklahoma, the 2024 failure of a community bank left a local manufacturer, and I think it's important to hear names, Brandon Connor from C-Star MFG, who reported a $150,000 loss on his uninsured payroll accounts. We saw the cost in real time when Silicon Valley Bank, also known as SVB, collapsed. An Ohio-based payroll company, Patriot Software, suddenly had its accounts frozen. Overnight, 8,100 small businesses across the country could not run payroll. One of them, Fry the Coop, a restaurant in Chicago, missed paychecks for 227 Americans. For those workers, this wasn't a debate about liquidity or systematic risk. It was rent, credit card bills, and groceries that couldn't be paid. And I can't help but think who wondered who paid their late fees on these monies. A second payroll company, Rippling, had $545 million for payroll clients frozen, way above the $250,000 NCUA and FDIC insurance limits. How can we hold working Americans responsible for where their employer banked and in turn where their employer's payroll company banked? Most of our states don't even teach basic financial literacy, let alone high-level finance. These cases highlight the urgent need to secure payroll accounts for real and all Americans. So far, the only message we've sent is that Main Street has been, if you're big, you're safe. If you're local, you're at risk. This isn't just an economic issue, it's a national security issue. The DoD depends on small businesses for critical parts, innovation, and supply chain resilience. Small firms provide over $80 billion in annual contracts for DoD, and $59 billion move through subcontracting. When big bank failures threaten small suppliers, defense programs are at risk. In 2023, firms building drones, propulsion systems, and defense AI nearly missed payroll because their cash was tied up at SVP. It was a near miss with national security consequences. History from the 1980s, savings and loan crisis, to the 2008 recession shows that when small banks fail, small defense suppliers exit the market. That weakens our industrial base and ultimately our deterrence. What can Congress do? First, targeted coverage for business payroll accounts. 2, price risk properly. SVP had 95% of their deposits were not covered by insurance. 95%. How could employees at Friday Coop even understand that?
You have about 15 seconds.
Strengthen mid-sized banks, standardized reciprocal deposits for protection, clarified systematic risk, and protect defense supply chains. Direct DoD to provide emergency bridge funding finance for small businesses when bank failures threaten our national security. Let us not ask what small businesses can do to survive our financial system. Let us ask what our financial system must do to ensure small businesses and the nation they sustain endure.
Thank you.
Thank you, sir.
We'll now turn to questions and answers. And the first question I was going to ask is, if too big to fail only gets bigger during a crisis. Why is that? All of you have answered that question, so I really appreciate that. We've heard a lot about the $250,000 limit. My hope is that if this banking committee decides to act, that whatever number we come to, we will at least index that number so that the number will keep up with reality. Third, we've heard a lot about the payroll accounts, which of course is very important for us to figure that aspect out. But I also would like to hear from you all talk about just the basic limit. What should the limit be? And as you discuss that, and hopefully take a couple of minutes of my time on the question, what's the downside? What are the risks? What are the costs? And how do you balance that with the benefits? Start with you, Mr. Kelly. Take 20, 30 seconds.
Chairman, thank you for the comment. Great to hear your thoughts on the indexing. That fits with one of our recommendations. The concern about the new limit and what it should be, as I testified earlier, we don't know what that number should be. We think it should be empirically based. We had on my task force individuals from GSIBs all the way down to small banks and had fierce debate on how to approach this. And what I can tell you is unanimously we believe that there is more data that we need to look at. Go back to the spirit of the FDIC, which was to promote public confidence and stability. At one point in time, that number was as high as 80 and 90% based on our conversation with Vice or Interim Chairman Hill. Today, only 57.7% of deposits are covered today that are insured, 57.7%. That's actually in your staff's memo, and I want to thank them for the great job they've done there. Thank you, Mr. Chairman.
Anyone have a different perspective on that question?
Chairman, I'd like to have a few comments, if you don't mind. Thank you for the question. Like Kenneth, I also firmly support indexing, whatever is agreed upon. I think that makes sense over time. When we surveyed our members, we had about 40% coverage at $250,000. That moved up pretty dramatically to 90% at the $5 million level. And then when you get to 20 million, you really cover about 98% of the operating accounts. And that made sense to us because, that's covering the vast majority. At the same time, you're not having customers try to figure out who they should bank with. And that really is, I think, a big difference. People just don't know how to do that analysis. So thank you.
Thank you. My next question is, which banks should be covered by an increased limit of FDIC insurance? Is it all banks, some banks, small banks, threshold 10 billion, 50 billion, regional banks? Nicholas?
Sure. Thank you, Chairman Scott. I would say that the potential danger of putting a threshold in statute is that they get outdated quickly. You look at, Dodd-Frank had a $50 billion threshold for, systemic risk. That was increased by Congress in 2018 to 250. That is now 7 years removed. And so is that number the right number today based on, thresholds? That said, do you ultimately want a situation where you have deposits moving from smaller institutions to large institutions, right? That is something to consider as far as where the threshold lies. Again, I would also support my colleagues on the panel here of saying that indexing is absolutely paramount because, once you put something in statute, it tends to be fixed, right? And then without an index, you're going to have, an outdated threshold that is, 5, 6, 7, 10 years down the road that is no longer valid. So I would caution on, making sure that there's a proper index of any threshold.
With my remaining 45 seconds or so, Mr. Kelly, how do we make sure that we don't disadvantage smaller institutions under $1 billion? Credit unions also bear that burden, as well as a cost structure that actually works versus one that sounds good but runs more institutions out of business. With 32
Yeah, Chairman
seconds.
Scott, real quickly, I think what you've said is important, that we shouldn't pick winners and losers in the banking space. I see the banking space as a system. I'm an engineer by training, and I look at things from a broad perspective. And there is merit to the largest banks that we have in our system, which makes us the strongest in the world. But we also need the capillaries in small towns like the one I grew up in Eufaula, Alabama. And so I would suggest, as we think about this, we apply a process that certainly creates consistency so that the customer is agnostic to which bank they decide to use.
Thank you. Ranking Member Warren.
So thank you. I actually want to pick up right where Mr. Kelly is about picking winners and losers. We absolutely pick winners and losers right now because the winners and losers game is if things get rough in the banking industry and it's starting to look scary, get out of the small banks because the federal government will only step in behind the big banks. And that's not just a tale, that is literally what is happening. And we've watched it happen. Nobody bails out the little guys. They only bail out the giants. And that's not just a problem for banks. That's a problem for how we finance small business in America. Big banks, I get it. They have their role to play. But their role to play is not how to help the local drugstore, is not understanding this local manufacturing business that's trying to get itself started, and you understand the bumps and when the money's going to be there and when the money's not, and you try to work with them and put them on a payment schedule that works. It is these small banks and medium-sized banks that do the handcrafting that kind of work demands. So this policy, excuse me, is not about trying to pick winners and losers. It's about trying to level the playing field again so that depositors understand the bank I work with year after year after year is a place I can safely keep my money even in troubled times. So let me start there. Mr. Harrison and Mr. Rice, you both lead smaller financial institutions. You play important roles in your community. What happened to deposits at small and mid-sized institutions like yours when SVB failed? And does deposit migration affect your ability to be able to lend to the businesses that you want to be able to support? Why don't we start with you, Mr. Harrison, and then I'll come to you, Mr. Rice.
Thank you, Senator Warren. Right after that, there's an intense amount of just uncertainty. We called hundreds and hundreds of our clients. All of my peers did the same thing in the mid-sized banks. We were fortunate. We didn't have a lot of money leave our bank, but honestly, right afterwards, we proactively did some Federal Home Loan Bank draws just to make sure that we had liquidity. Because that liquidity, that certainty of liquidity that's in those operating accounts is what we use to make loans. That's what we use to put back into the communities. And if you're not certain it's going to be there, you have to make sure it's there. So that's much more expensive to go out and get that kind of funding. But we did that. Many of my peers lost significant amounts of deposits in the week after that happened.
So SVB fails and you end up spending a lot of money.
We want to make sure we're safe.
Yeah, I appreciate that you do, but that isn't free. Mr. Rice.
Thank you, Senator. Thankfully, credit unions were untouched during this crisis. It was seen as a banking crisis, but it's not lost upon us that fear doesn't understand the distinction between banks and credit unions. It's the system. So on this occasion, we were lucky, but much like Mr. Harrison has pointed out, that big banks lend out 50 to 55% of the deposits. Credit unions lend out 90 to 100% of deposits. So 550 billion is taking out of the small bank and credit union system. That's a lot of loans to local communities that are at risk.
So you really have the potential here to contract the economy. One failure over here causes contraction in lending rapidly throughout the system. So tell me about the right number. You two lend the money out. Obviously, I think what you're telling us, what your customers are telling us when they flee, is 250,000 is just not a high enough number. That these transaction accounts that involve payroll and all are above it. Can you just give us an idea of what you think is the right insurance number, Mr. Harrison?
Well, I looked at our customer base and talked to some of my peers, and really in the different buckets, there's contractors, small, medium, and large, there's hospitals, there's small manufacturers. We just don't want the customer to have to decide. We think that $20 million number covers the vast majority of our operating accounts, so we're very comfortable with that as a group, as our 100 banks and the mid-sized banks. So that's the number we're comfortable with, but 250,000 just does not seem to be enough.
Mr. Rice, how do you feel about that number?
You heard my testimony, Senator, that Rippling had $545 million in their payroll account.
Yeah.
And 250,000 obviously didn't come anywhere near covering it. We also support at least 20 million, but it should be important. I don't agree with the term small business because to them it's the biggest thing in their life, and to call it small is kind of, it's interesting. It's a little demeaning, to be honest. And small businesses range up to 500 people in employment, and that's from the SBA. That's our own governmental definition. So it can be above 20 million, but we do support 20 million. But we do think you need to look at payrolls and payroll account companies and think of a way to include them in it without necessarily including insurance premiums.
Thank you.
We do tackle it.
Thank you. Thank you, Mr. Chairman.
Yes, ma'am. Just in case someone's wondering, we did invite the big banks to be here today.
Where are they?
I don't see them. Senator Kennedy.
Mr. Rice, you think we ought to raise the deposit limit to 20 million, right?
And that's for payroll accounts, sir. Yes.
And Mr. Harrison, you agree with that?
I think that'd be helpful, yes, Senator.
Mr. Kelly, how about you?
The recommendations we put forth, Senator Kennedy.
Just give me a number if you would.
I don't have a number. Our recommendation is it needs to be studied and empirically based.
Okay. Mr. Podsiadly?
Yes. Yeah, thank you, sir.
My colleagues are impressed that I can pronounce it.
I'm very well done.
I'm kind of impressed myself.
I used to get a lot of starts with a P going in my undergraduate and high school.
All right. I'll call you Scooter. How,
I'll take that as
give me a number.
I would agree with Mr. Kelly that it needs to be empirically based, and
Come on, guys. I know it ought to be empirically based.
Okay, well, I'll say this. The one concern
You
that I
used
do
to work
have,
at FDIC. Give me a number.
yeah, well, the one concern I have is some institution loading up on a significant number of $20 million deposits that then ultimately.
So if you don't like 20, give me a number.
I don't have one off the
You're
top.
not going to give me a number.
I will give you my best guess, which is that 250 is not high enough, and 20 million is probably too high.
How much?
I said 20 million is probably too high.
Okay.
Because I worry about.
Let's suppose we go to 20 million.
Yeah.
Banks are going to pay this through assessments, right?
Yes, correct. Risk-based.
Okay. Mr. Kelly, who's going to push back among the banking community?
Senator Kennedy, I'm not sure who will push back on that.
All right, Mr. Harrison?
I think there's some smaller banks that will feel they don't need it, their deposit accounts aren't that large, and they would be, not as willing to do that. I think some of the banks that currently have coverage for free will likely push back. Or
Some of the what?
Some of the
Larger
banks
banks?
that have implicit coverage
of the larger
for
banks?
free, generally the larger.
Some of the
banks.
larger banks?
That is correct.
So you think the larger banks will oppose it?
I don't think they'll support it. I don't know if they will oppose it.
How about you, Scooter?
I love the new nickname. I will take that as a warm regard. But
It is.
I would say that my bigger concern is the aggregation of deposits.
Who's going to push back?
I don't know that you would have any institution that would push back other than as
Everybody be happy.
well. It depends on what the cost is, right?
Mr. Rice, who's going to push back?
Not our 144 million members, sir. They'd be delighted that their paychecks are guaranteed.
Who's going to push back, though?
The bankers, sir, the large banks.
The large bank.
They're not here today, and I think their silence is implicit on their stand on this.
Okay. So here's what I hear you saying. 20 million indexed to inflation, but the large banks are not going to like it because they have an implicit guarantee. Does anybody disagree with that? Does anybody disagree? I certainly don't with Senator Warren's assessment that the big banks don't have to worry about it because they're going to be bailed out. Does anybody disagree with that? Okay.
Well, let me add a little color, Senator. I think perspective. So I led a committee. And
I'm sorry, sir.
I led a committee that included banks of all sizes.
Right.
And one of the things I learned in leading that committee is that there is a lot of complexity associated with the prudential regulatory aspect of those larger institutions. Their liquidity requirements are very different than mine at $700 million a year. And so it's something that I had to become sensitive to as a leader of that group. And so while we sit here.
Kelly, let me
while-
stop you. I understand. You're a smart man and you're a successful man.
Well, I appreciate the
And
compliment.
I
Senator.
appreciate that. But you're telling me here today, all of you, we've got a problem. And
Correct.
we're not going to, this isn't directed toward you, sir, but we're not going to solve this problem by pondering our navels. We're going to have to come up with a number and index it to inflation. Taxpayers won't pay, the banks will pay. And then find out who's going to push back and why. I mean, that's the challenge. I understand the difficulty and the nuances and the trade-offs. I get all that.
Thank you.
And you make, I don't mean to denigrate your analysis, because you know a lot more about this than I do. But you're saying we have a problem. I'm asking how we solve it. And what I'm hearing is $20 million, index it to inflation. The larger bank's going to raise fresh hell.
Fresh. Senator Cortez Masto.
Thank you. Thank you, Mr. Chairman. And let me follow up on Senator Kennedy's line of questioning. Mr. Kelly, and I think both you and Mr. Patziadli talked about this, the need to be studied, and you talked about empirically based. What do you mean by that?
Senator Cortez Masto, I would say to you that we want to be, if you look at the history of how we've made these decisions, they've always been in crisis. 2008 was a crisis, the permanency in 2010. You go back 28 years before that, we made a decision in 1980 to raise it to $100,000 in the midst of a crisis. And what we believe is there is enough data there with the approval of the FDIC to look at its original intent to provide safety and confidence in the financial system that can cover where individuals don't have to make the decision whether I want to bank at Kenneth's Bank or the largest bank, creating that sense of safety. What Senator Warren mentioned a moment ago is implicit that there was not that level of confidence in the system after 2023. And what we're suggesting is there's the data there that we should be able to run, come up with a reasonable solution, and make that going forward index to inflation.
Mr. Patziadli?
Yes.
Say that again, because I'm not going to call you Scooter. Patziadli?
Patziadli,
Thank
yes.
you.
Thank you very much. No, I would offer a little bit of a countervailing perspective, which is I come from a regional banking background. I've been at 2 large regional banks, and I will say during our experience while in 2023, we had the unique opportunity, which was we did see the deposit runs starting to come out of the bank, but we put together a Tiger team, and we spent every single day, every day at 5 o'clock, it was everybody from commercial bankers to consumer bankers to legal risk getting together and saying, how are we winning the deposit battle? How are we stopping these outflows from happening? And we were able to do that at the bank at that time. So there is the ability to stop these outflows from a too big to fail perspective. It takes a lot of work. I will tell you, we worked our tails off to make sure that that didn't happen. And the bank ultimately was able to keep, we were one of the few banks, regional banks while I was there at my prior employer, to grow deposits during the outflow market. So it takes work, but yes, it can be done.
So let me ask Mr. Rice and Mr. Harrison, do you see a distinction amongst, if we're just talking about the type of account, which is a payroll non-interest-bearing commercial account, do you see a distinction there that some should have different levels of coverage or not?
Peter, if you don't mind, I'd go first. Is we do, and we're longtime members of the ABA. We're fully supportive of the work they're doing. We think the analysis is there. We think the facts are there. It's not a crisis today. It was a crisis 2.5 years ago, and I think now is the time, in a period of calm, to really look at what was the specific problem. The problem was uninsured operating accounts, and the solution is what we're proposing.
Okay.
Or what? Sorry, Senator Haggerty and Senator
Right,
Alsop.
that you believe there's enough data already?
We feel, and the
for that.
FDIC came out in the 2023 study and did on that and said, you know, if we looked at operating accounts, that would be a potential targeted solution. That was in their analysis.
Okay, Mr. Rice?
Senator, on a broader level, I'd like to boil things down to what's talked about on the street. We wouldn't allow Americans to underinsure their homes or their motor cars. Why do we allow that asset class to go uninsured? So that's the first point I'd like to make. Secondly, I think my testimony demonstrates the risk to everyday Americans when payroll companies fail, because the amounts in those payroll companies tend to be way larger than $250,000.
Yeah, thank you. The other thing, and I think, Mr. Rice, you talked about this, you talked about the impact to the employees and
Yes.
to these small businesses. But you also, in your, I believe it's in your written testimony, you talked a little bit about national security issues.
Absolutely.
Will you address that a little bit and why
Absolutely.
this is such an important for us to take into consideration?
Absolutely.
as
For many years, our government has sought through various programs, including SBIR, to make sure our national security resilience remains strong by spreading contracts out to small businesses. One example I gave is in everyone's living room right now, it's Roomba. The Roomba was originally designed and supported by SBIR for bomb disposal in Afghanistan and Iraq. So it saved lives, and now it cleans living rooms. But that's the power of not just a national defense issue that can be turned into everyday benefit for Americans. So these companies are really vital to our economy and to our defense. I think I also highlighted Lockheed Martin. Gives out $6.6 billion in contracts to small companies, and the Orion project, which is our deep space program, has about 1,500 small businesses in support of that program, and almost every senator's district is represented in that program.
Thank you, Mr. Chairman.
Thank you, ma'am. Senator Haggerty, you are next.
Thank you, Mr. Chairman. In March of 2023, we saw 3 of the 4 largest bank failures in history take place. And when panic struck, business depositors began to flee mid-sized banks and community banks. I had these depositors calling me on the phone. What do we do? I hear about the hard work that you're talking, Scooter. There was a lot of work that went in place. You ask yourselves why? Why is that? And I think Mr. Harrison got it. The biggest banks enjoy an implicit government backstop that the smaller banks simply don't have. This uneven playing field siphons deposits away from the local and regional banks. These are the banks that fuel the small businesses and local businesses in our economy. It's critical in Tennessee. It's critical across the entirety of the United States. Legislative action, I believe, is essential. Nobody wants to see the American banking system devolve into a system like Canada's, where only a handful of mega banks control over 90% of the assets. We need a system that preserves a central role for community and mid-sized banks that underlies the financial system of the future here in America. So, Scooter, I am going to come to you. But I have a very quick question for you, Mr. Harrison, because I want to get at the urgency of this. Why is it vital to address this issue now rather than wait till the next crisis?
Senator, thank you for the question. Thank you for your leadership on this topic. It's essential now because we're not in a crisis, because we don't have to respond to something that is knocking on our door. We never seem to predict when the next one's coming. So if we don't do it now, we really are uncovered because we don't have any emergency authority at the FDIC, and our businesses on Main Street don't have coverage for their operating accounts.
Thank you. I share your concerns, of course, and that's why, with my colleague, Senator Brooks, I proposed a solution, and that's a targeted expansion of deposit insurance for these non-interest-bearing transaction accounts that we're talking about. These are accounts that businesses use to cover payroll, cover rent, pay their suppliers, and basically handle a variety of other day-to-day expenses. These are precisely the funds that fled in 2023, and protecting them strengthens the confidence in the community and the mid-sized banks. That, in turn, will strengthen Main Street, and it'll strengthen our economy overall. I originally filed this proposal as an amendment to the NDA alongside Senator Brooks, and we're going to file soon a standalone legislation in an updated fashion to get at this. So, Mr. Pontiatley, Scooter, I'm coming back to you now, because I think you can help us get at this. There seems to be a concern that in doing this expansion, somehow we're going to raise the assessments on the very banks that we're trying to help. I want to help get at this. So I've got a few questions to ask you.
Absolutely.
First, does merely shifting the existing deposits from the uninsured column to the insured column cause an ipso facto increase in the bank's total liabilities?
No, not
course not.
necessarily. It's risk-based, and so it would depend on a number of factors based on the current assessment formula.
I think the answer of no is sufficient on that one. Insurance coverage expansion doesn't mechanically raise premiums for banks. To be clear, increased assessments are statutorily triggered when the deposit insurance fund's reserve ratio drops below its mandated minimum. So my next question, is the DIF currently overfunded beyond its statutory minimum?
I think that is a question of characterization. I don't know that it is overfunded or underfunded, but I would say this, that the DIF, if you add new risk to the system, namely institutions that could load up on these types of deposits that are now insured, yes, that could raise a question to the DIF from a characterization.
To be cleared for my colleagues, the DIF is currently overfunded, just to be clear with that. The reserve ratio is adequate. It's exceeded its required mandatory level, and it's actually trending upward. And this is why, in addition to a 10-year transition plan that we've got for this, it's precisely why my proposal is able to expand coverage without imposing any new assessments on the system. So I'd just like to close with this, my colleagues, to understand that this targeted deposit coverage expansion is going to do something to shore up confidence in mid-sized banks and community banks, and it's going to protect Main Street businesses. A stronger, more diversified banking system benefits every American, and I look forward to introducing standalone legislation, again, alongside Senator Brooks, in this particular issue, and I think it's going to serve America well, it's going to serve our banking community well, and I urge my colleagues to support this. Thank you.
Thank you, Senator. Senator Warner.
Thank you, Mr. Chairman. I want to follow up on Senator Hagerty and Senator Brooks. I think I agree this is something we need to do, and I appreciate, Senator Hagerty, your good work here. You know, I love to have the discussion about if we do add more contingency. You know, Mr. Potsley, am I screwing up your name? Or so we just call you Potsyadsley. You know, I do think the DIP right now is overfunded, but I think we got to get into the nitty gritty on this. But I agree with, looking forward to working with Senator Hagerty and also Brooks on this. I want to, one of the things I've been frustrated with, we're years after Silicon Valley Bank, and I always felt before we start rechanging the regulatory structure, we ought to make sure that we're using the tools we've got. And one is the discount window. And so I've been working for a long time on trying to remove the stigma, and I find it not a great reason that you've got, when the Fed was initially set up, the discount window was that liquidity tool, And just the idea that, well, it's going to be a stigma is somehow, that means we shouldn't use it. I've got legislation that would have this better utilization, demonstrate that banks can use it on a ready basis. Silicon Valley didn't even have even anything set up to do that. So we only use the deposit insurance as a last resort. One of the things my bill calls for is to look at pre-pledged collateral. And would you agree that that tool is something that should be counted as banks look forward? And how do you generally think about better utilization of the discount window?
Well, thank you, Senator, for the question. And I would say this, that, liquidity is the ultimate arbiter of a bank run, right? Like, liquidity kills. Right. Like, you can have as much capital as you want, but if you're not liquid, you're going to have a run and you're going to have an issue. So anything that establishes or creates a more liquid opportunity for banks to get funding is helpful. And I would support that.
And one of the things there was a lot of buzz after Silicon Valley about how we grapple with the ability to have accelerated runs driven by technology. And candidly, I think some of the folks who spooked the market bore some responsibility. None of that went anywhere in terms of, no matter what kind of capital you have, if you've got 1 out of every 4 deposit dollars leaving the bank in 6 hours, as was the case with Silicon Valley, I'm not sure how we get at that. I want to go to, and I would welcome ideas. Mr. Harrison, Mr. Rice, one of the tools that I've also a big advocate for is reciprocal deposits. We've seen a big upsurge in that. How do the reciprocal deposits ability fit into this discussion about the insurance component? And I've got a question for Mr. Kelly afterwards. So I want to hear Mr. Harrison and Mr. Rice on this.
Yes, Senator, thank you for the question. The reciprocal deposits have a role, but candidly, it is a workaround. And it's a workaround that is private-based, based on somewhat dated technology. And candidly, it went up quite a bit after Silicon Valley, and there's some systemic risks that could be seen in that. Going back to your discount window question, the regulators and the banks have been working very closely on that to smooth the operation of that. So it's an operational issue as well as the stigma. And I think that stigma is going to go away over time.
Mr. Rice.
Reciprocals are great, sir. Reciprocals were $67 billion before the crisis and rose to $173 billion in banks. So there's a capacity issue. So it's a nice little tool. But I also want to point out that First Republic survived the first wave of bank runs. Banks put in another $30 billion. But it was the reports that said they lost more deposits than initially reported caused the second run, which the bank could not have failed. So your point, sir, is right. You do need to stop fear in its tracks when it enters into our system.
And again, the excuse that we don't want to use the tool because of stigma, we just have to grapple with that. Mr. Kelly, I've been a huge advocate for CDFIs, as we've visited in the past. One of the things that we've started, and again, with great help from Senator Crapo, Economic Opportunity Coalition, where we're trying to get long-term deposits into CDFIs and MDIs. How do we do more of that? Because we obviously, and President Trump ought to get credit for this. He's now kind of undermining CDFIs, but he was the godfather in terms of the last COVID bill. We got $12 billion in Tier 1 capital. How do we make sure we keep these Economic Opportunity Coalition ideas alive?
Senator Warren, thank you for your leadership. You do recall that you were part of that leadership that helped ESIP happen during Trump 1.0, and it has certainly been impactful to the CDFI space, so thank you for your leadership in that regard. In most cases, many of our banks have used reciprocal deposits as an opportunity to create that level of security with those large depositors for our banks. And so it has been a critical component. I don't think it is the answer in totality, but it certainly is a complementary component of this. And so I'd just like to tell you thank you again for your leadership on this topic. I think this is what we propose is what you're describing.
Can I just, I know our time's up, but I just would urge my colleagues, many of you are part of the CDFI coalition. Secretary Bessent has been very supportive of as well. We've got about $600 million that hasn't been released. The Secretary wants it, but we really could use some some help getting those dollars released before the end of the fiscal year. Thank you,
Senator
Mr.
Britt.
Chairman.
Yes, sir.
Thank you, Mr. Chairman. I want to welcome all of you today. Thank you for taking time with us. Mr. Kelly, a special thanks to you being here as a native of Alabama, Eufaula, Alabama, just right down the road from my hometown of Enterprise. And I think you'll understand this, Senator Kennedy. He is a true bipartisan witness. He graduated from Auburn University with his undergrad and then graduated from the University of Alabama with his MBA. So
Thank you, Senator Kennedy.
we are certainly proud to have you here today.
Thank you, Senator Britt.
Look, I think so much of today's discussion is clearly in light of the deposit flight we saw after the March 2023 bank failures that occurred. I think it's important for us to take this in context. That was clearly a mismanagement issue. That was clearly where we had unchecked banking executives and supervisors who truly failed to do their job. It is not a testament to the resiliency that we saw within the banking community. I mean, in Alabama, we saw continued strength even through the face of that. And so I think it's important to lay a foundation of that before we have this discussion. I do want to get your thoughts on a couple of things. So often we see this committee and then this body and Congress as a whole create regulations that, to me, become outdated very quickly. I've heard each of you speak to that, and it seems that you all feel the same, particularly when it comes to potentially indexing these things or making sure that there is fluidity so that they're not outdated by the time they even get in. I'd like for some of you, I mean, I know that's one of the things I've looked at with the SEC small entity definition. I think it's virtually meaningless, and I have a piece of legislation that would work to move through that. But I think we've seen this a lot when it comes to the Dodd-Frank Act, amongst a number of other things. So if we're taking a look at this, I think it's important that we consider indexing or other thresholds that will make this more meaningful long-term. I'd like for each of you to talk briefly about what you think that needs to be. And again, we only have a certain amount of time, so if we could quickly, we'll start with you, Mr. Rice, and just work our way down.
Thank you, Senator. Index it to inflation, FDIC 250, that would be $350,000 today. Any recommendations from this committee, we should also do the same.
Okay.
I agree completely that, when we look at thresholds that get outdated quickly, as I mentioned earlier, Dodd-Frank, was obviously changed by Congress in 2018 to, from 50 billion to 250. Now we're 7 years removed from that. Like, is 250 the new number, right?
Right.
Does it need to be changed?
Right.
And so indexing that, I think, is a good way of getting at that issue.
Okay.
I agree. Indexing, Senator, is really important. The other thing is the world changes, and sometimes these limits have to change with them.
Okay.
I agree, Senator.
Okay. So question for you all. I've heard us talk obviously a lot about business accounts, and I think we all understand the importance of that and payroll, et cetera. My question, I'd like to follow up, since we've gotten some answers on that, about personal accounts. Do you feel like that actually needs to be increased as well? Mr. Rice, we'll start with you.
I do, even based, Senator, on your indexing idea, that would be $350,000 today.
Okay.
I think that you need to look at it from an individual level, because there's a lot of different ways that you can increase that deposit insurance cap. It's not just 250. So say you're married, you get 500, right? Because you get two.
But do you not think it puts smaller banks at a disadvantage, where you have larger banks kind of sort of too big to fail, that people are even moving some of their personal accounts over there?
It would absolutely depend on what the dollar value of those individuals' accounts are, right?
Because what I'm concerned about is when I see these incredible community banks across Alabama and the resiliency that they've shown in the face of sometimes the unthinkable. Those are pillars of community that ultimately allow our small businesses and their main streets and families who are trying to achieve their American dream to thrive. And in many cases, what we don't want to do is see what we're doing here in this committee and Congress drive them to a larger entity, when I feel like it's so essential for them to stay a part of the community that I think serves them so well.
I absolutely agree. I think that Main Street banks are the linchpin of our
100%.
consumer economy. I just think that there are ways, to be honest, that you can structure those accounts so that you can make sure that you maximize.
Well, I'd love to talk to you about that more. I'm running out of time. I apologize.
I apologize.
Go ahead.
Senator, so for me personally, I don't speak on behalf of the organization. We haven't had this question on the personal side. I support it. Indexing for sure.
And then Mr. Kelly.
Yes.
Okay, and Mr. Kelly, since you obviously understand the community banking world, what are the challenges that we have in front of us if we are to increase this, either on the business or the personal side? side. What I've heard from some is kind of a concern about assessments and the shifting there and kind of what that means long-term. Can you speak about the positive and the negative of what this would bring?
Yeah, I think being very deliberate, if this body approves the recommendations we've put forward, put some energy behind moving very swiftly on it. This is
Okay.
not a 2-year study. We found even in the 2008 timeframe when the decision was made, they've been talking about deposit insurance for years prior to that. We need action now on this and need your leverage, your leadership to help make this happen sooner than later.
Yes, sir, and War Eagle and Roll Tide.
Same here.
I'm not sure what she just said, but Senator Smith.
Thank you, Mr. Chair. Thank you to all of our witnesses today. I want to start by following up on the questions of my colleague from Alabama, because Minnesota is also home to, I think, more than 300 community banks. We're really blessed that we have such a diverse financial ecosystem in Minnesota. And when, Silicon Valley Bank and Signature Bank, when all of that crash happened a few years ago, I mean, of course, there was a lot of anxiety amongst all of the financial institutions about kind of what this fear factor was going to mean for them. But at the end of the day, I think I pretty much have this right. Because those small banks were so rooted in their communities and were so trusted by their customers, everything just sort of settled down, I guess is the way I would describe it. So I want to follow up on this question. How can we, I'm convinced that we need to raise the deposit insurance cap. The idea of indexing it makes total sense to me. But my question, I guess, maybe to Mr. Kelly and to start with is, how can we make sure that we're also reflecting the needs of these smaller banks and that we are not imposing unnecessary costs on them or just making it more difficult for them as we also want to have sort of the benefit of a higher cap?
Thank you, Senator Smith, for the question. I would tell you, it really, the foundation of this is our leadership locally. To your point, we had moved into your market in 2022, and this happened in 2023, and we got just a couple of calls about our stability as an institution there in the Twin Cities. But through our relationship, that water did calm down. We went to events like chamber events and other nonprofits, and that question was continuously open: is my money safe? And I think we have to be the leaders to help set the tone that we are looking after this not only in crisis, but in moments of calm. And so I thank you for your question on this. Again, I thank my colleagues because they've done a great job in looking at the research as it relates to their banking. Bob just mentioned these numbers. I think the intent is we need action now on this topic.
And we can do this without imposing additional burdens or costs on these small community banks that are, honestly quite stable.
Well, we've talked about the data. We need to look at both sides of that. So I can't commit to what it will cost, but I think we can approach this in a reasonable manner and such that we do provide that stability and confidence, as was the mission of the FDIC.
Mr. Harrison, there's been conversation today about how, and this is my view of it, that in a lot of ways our financial, this my words, not yours, that our financial system is sort of rigged to help the big banks, the biggest banks, I mean to say, the GSIBs. And sometimes we might be putting mid-sized banks, not to mention small banks, at a competitive disadvantage because of that implicit guarantee that the big banks, the biggest banks, have. So I'm concerned that the $250 billion threshold that is in the Hagerty and also Brooks legislation, I'm wondering whether that's the right threshold, whether that doesn't create some sort of perverse disincentive for mid-sized banks that fill a very particular and important niche at least in Minnesota's financial ecosystem. Could you speak to that?
Thank you for the question, Senator. The mid-sized banks, really what we're looking for is a level playing field, and I don't think we have that. And that goes to the meat of your question. So what is the right number on the upper end? I think many of the larger banks, talking to my peers, larger peers, they also saw deposits leave. The concern is if we do nothing, the deposits will continue to drift towards the largest banks. And not having some type of coverage, and the sooner the better, would continue that trend.
And I would agree with you on that. I think that that's something that we should that we should really look at. And that kind of deposit migration is completely unrelated to the underlying stability of the bank and the management of the bank. It has to do with this sort of perceived additional safety that can be achieved by being at banks that are going to get bailed out because they're systemically significant.
And I know we talked about a former employer that didn't lose deposits, but many of the larger banks did. And they still went to the GSIBs.
Thank you very much. I yield back, Mr. Chair.
Thank you, ma'am. Senator Ricketts.
Thank you, Mr. Chairman, for holding this hearing today. I appreciate it, and to the ranking member as well. And thank you for our witnesses for being here today. As been mentioned, when Silicon Valley Bank and Signature Bank collapsed in 2023, it wasn't just their customers that were affected. We saw commercial deposits flow out of small and mid-sized banks all across the country and into a few of the larger banks, as you were just describing, Mr. Harrison. This wasn't because those financial institutions were suddenly weaker. In fact, many of them were very well capitalized and stable. It was because businesses with balances above the FDIC's $250,000 limit realized their funds might be at risk if they stayed at a smaller institution and shifted their money to one of the bigger banks overnight. That left our small and mid-sized banks, community banks, regional banks, and credit unions at a disadvantage, scrambling to retain funds and making it harder for them to keep serving their local communities. And similar to my colleague from Minnesota, Nebraska community banks are the lifeline of our communities. We don't really have any of the big banks. Our largest bank would be First National Bank of Omaha. And these are the ones that finance our farms, our businesses, and really provide for our families' livelihoods. So they support job creation, provide capital, small business growth, and keep our local economies thriving. Mr. Harrison and Mr. Kelly, you both represent financial institutions of various sizes, and I think you answered a yes or no question about after the collapse, did you see deposits flee? Can you talk a little bit about what degree did you see commercial depositors moving funds away from your institutions?
Senator, we did not see movement. We had a pending deposit that was about to happen when that happened, and it was put on hold.
Okay.
So if I recall correctly, I think several of my colleagues have said pretty much the same thing, where they had to fight for deposits, but I'm not sure that these individuals at this table, unless I missed something earlier, saw flight from their respective banks.
And so did you see then that this didn't happen, and so there really, even after things died down, business kind of went back to normal? Is that accurate?
I would say business came back to normal for us and in the midst of the crisis. But the reality is we know that there was flight that took place based on our conversations with colleagues. And what we're trying to do, and what the clarion call from this panel, I will tell you, is we need action now before a crisis happens again.
Mm-hmm. And Mr. Rice, would you say that was accurate for your credit union as well?
Credit unions, because of the reputation and ownership structure, sir, did not. Credit unions actually grew 2% during that period because of the stability of a credit union. But again, contagion and fear are dangerous. So when the next wave hits, it could take anybody out.
Mm-hmm. And so, Mr. Kelly, you said some of your colleagues saw some of that fear or some of the deposit, even if you didn't experience it yourself. Did some of the other institutions that you know about, did they see those deposits start coming back after things kind of settled down?
I don't know the exact answer to that, Senator. Just don't know the answer to that. But that was from some of my colleagues in the Mid-Sized Bank Coalition. Bob may be better to address that issue than I.
Sure.
Maybe, Senator, to touch on that. Us personally, we lost several tens of millions of dollars, but not significant relative to our size, and it did go to the GSIBs. But some of my peers, they lost up to 10% of their deposits within a week, and a very significant amount of deposits. Some of that came back, but not all of it.
So some of it did come back, but not all of it.
Not all of it.
Again, getting back to just the perceived risk from.
That's correct.
Yeah.
Once it moves, it's much harder to get it back.
Yeah, very good. Mr. Adley, sorry. In your view, what risks does it pose to long-term competition and credit availability in local economies by having the risk out there that these deposits could flee?
Well, great question. And, to follow up on the colleagues on the panel here, obviously our experience was a little bit different when I was at my prior employer at the bank. We put shoe leather down and really, ground it out and made sure that we kept those deposits so that they didn't leave. That said, from a, systemic risk perspective, that, obviously my former hat as a regulator concerns me a little bit, that you could increase the concentrations at, smaller depositories. Say they load up, 20 million here, 20 million there, 20 million there, and all of a sudden they're at, $500-600 million in, now insured deposits. Is that going to create systemic risk to the platform as a whole, right? And is that going to be cost-based into the system? That is something that, from my former regulator hat, worries me a little bit.
Yeah, I'd have to disagree with that. I'm sorry, because I think that by balancing, leveling the playing field, we're spreading out the risk. What we're doing now is we're concentrating it in a handful of institutions.
Can I just have one more quick question? Mr. Chairman? No, I guess that would be no. I will submit a question for the record. How's that? How's that, Mr. Chairman?
Well, actually, it's her time. We're eating. I know that we all have more commitments.
No, that's quite all right.
You want to give him 10 seconds to
Sure.
ask a question?
I was going to say, just
and not get an
Mr. Adley, is there just any other reforms you can think of that would be that are not in the bill that we ought to be considering?
Yes, and I'll take 20 seconds, and I don't mean to take Senator Alsobrook's time, but I would say the biggest thing that should be discussed is whether or not the systemic risk exception should be applied the way it was, because that created this notion that every deposit was now insured. Right? Is that good policy? I don't know. I will offer that I think that it is counterintuitive to the least cost deposit insurance test that Congress has created, and that should be something that's debated longer term.
Can I add in, if you don't mind?
Also Brooks. Oh, yeah.
Resolution and emergency powers, those two topics we had in our recommendations.
All right, thank you all very much. We're going to Senator Alsobrooks.
Thank you.
Thank you so much, Chairman Scott. Also want to thank Ranking Member Warren for holding this important hearing, and for our witnesses, thank you so much as well for joining us today. I'd also like to thank my friend Senator Hagerty for his partnership and for his leadership. I note, Mr. Chair, that my timer is not working here. So I will be quick. I'll just take 15 or 20 minutes to ask these questions, and then I'll be out of your way. Now,
Well, Senator, I am happy to give you a 30-second warning.
Okay, thank you, thank you.
Right around 5 minutes, since
Thank
it took
you.
so long.
Will do. After the Silicon Valley bank collapse, individuals and small businesses questioned the security of their deposits. Many believed that their deposits were only truly protected if they were housed at a large bank that had the implicit backing of the federal government. Now Congress, I believe, has an opportunity to provide greater certainty to small banks, credit unions, small businesses, and the workers they employ. Senator Hagerty and I have drafted bipartisan legislation to provide this certainty. Our legislation would expand deposit insurance to cover the business checking accounts held primarily by small businesses at small banks. These bank accounts are used to pay employees and maintain daily business operations, but are often uninsured, leaving them vulnerable if there's another Silicon Valley bank-style financial crisis. Our proposal will give businesses certainty that up to $20 million in payroll accounts held at neighborhood banks and credit unions will be insured by the full faith and credit of the federal government in the event of a crisis. This will help the Maryland small businesses that make up about 99% of my state's business community and employ more than 1 million people. I'm grateful for the support of the National Association of Women Business Owners, which praised our legislation and said that women business owners must be able to trust that regardless of their banking institution, they can make payroll. I'm also grateful for the support of the Maryland DC Credit Union Association, which represents over 65 credit unions in Maryland and their more than 1.9 million members. Their CEO said that our legislation would deliver critical peace of mind by safeguarding the funds meant to support jobs, pay salaries, and meet key expenses, which will strengthen trust in the financial system. So today, I'd like to just begin, Mr. Harrison, I have a question for you, and I want to thank all of you again for being here, and I want to thank you, Mr. Harrison, for your support. You spoke passionately about the importance of raising the deposit insurance level to cover small and medium-sized businesses in the event of a crisis, and I couldn't agree more. I'm proud of this proposal that myself and Senator Hagerty like Chairman Scott and Ranking Member Warren, want to make sure that we want to make sure we get this right. So can you talk specifically about how our proposal would help the clients you serve? Are there areas also that you believe our proposal could be improved?
Thank you, Senator, and thank you for your leadership on this issue. Really, it is a topic that is near and dear to us. It really supports the small businesses. I said in my opening comments, so much of the deposits that we get go back into the community and that support of the community, and really knowing that local hospital, that small business, being able to support them makes all the difference. It will just give more certainty in times of stress. When times are good, you don't need this type of thing. Nobody talks about deposit insurance. Very few people ever look at deposit insurance when they choose a bank. They just assume their money is safe. And that's what the whole regulatory environment's for. And that's what we serve our communities by making sure the dollars we receive go back into those communities. And looking at things to change, potential changes in legislation. I know there's talk about what the actual limit should be, how large an organization it should cover. Those are worth looking into. We haven't had a chance to really study it. But I do know that the proposal that you and Senator Hagerty have made will cover the vast majority of operating accounts that businesses need to rely on to make payroll, protect their working capital, pay their vendors, and it will achieve that. And that's a huge goal that would be beneficial.
Okay, just one more quick question. My time is tolling. An important question in any deposit insurance reform proposal is who pays for it and how. And so Senator Hagerty and I share the goal of preventing small banks from being disproportionately targeted. So, Mr. Harrison, would you, based on the current deposit insurance fund projections, do you think that our pricing approach and the 10-year phase-in would mitigate the need for an increase in assessment rates?
I do.
30 seconds.
I think the phase-in would do a lot, and then over that 10-year period, depending on what happens in the greater market, that would be more than enough to maintain the DIF at its current level,
Thank you so
which is
much,
fully
Mr.
funded.
All right, on time, under time. Thanks so much, Mr. Chair.
I have 15 seconds still.
I'll yield the rest of the time.
Okay.
Thank you.
Senator Warnock.
Thank you, Chair Scott. During the spring 2023 banking crisis, many small businesses struggled simply to pay their employees and to cover expenses only because those businesses chose the wrong bank to keep their money safe. Small businesses, in my view, should not be punished for the mistakes of failed bank executives. And that's why I'm glad this committee is looking at ways to reform deposit insurance. However, we should be careful not to place additional strains on our community banks, many of which serve populations and communities that giant Wall Street banks don't. Mr. Kelly, community banks in Georgia and across the country compete with big banks by knowing and investing in the communities they serve. Are you concerned about deposit flight to big banks where small businesses rush to put their money in the biggest Wall Street banks because they're nervous about keeping their money safe?
Yes, Senator Warnock, thank you for the question. I would tell you, whatever it is called, if you look at what took place in 2023, there was inherent flight that was moving because of nervousness and anxiety within the business community. And so the efforts that we're talking about today, hopefully will bolster confidence and allow small businesses to feel more confident in putting their monies in the small businesses in the small towns in the state of Georgia.
In fact, we have seen over the last 2 decades about a 50% drop in the number of community banks. And at the same time, Wall Street banks have continued to make more and more and more money, getting bigger and bigger. How should we ensure that small community banks, and let me be clear, I think there's a role in the larger ecosystem for the big banks and the small community banks. But we clearly, all the movement has been going in one direction. So how should we ensure that small community banks do not foot the bill for deposit insurance reform legislation?
I think it has to be carefully considered. We also have to ensure that there's adequate regulation, Senator Warnock, on this topic. Regulation can run and cause our businesses to be challenged economically. And you see, really, in looking at what's happening in the consolidation, a lot of that is economics. One issue I will bring up that's probably not part of this topic is when you look at things that look like a bank, act like a bank, and can buy a bank, it should be taxed like a bank. And my point is, we have a lot of inequities across the system that we need to deal with. Taxation is one of those that will allow these small institutions to stay in small towns like Griffin, Georgia, or Hayhira, Georgia. That's important to be sure that they become the lifeblood for economic prosperity in these small towns.
So this issue is further complicated by technology and other
Absolutely.
disruptors, correctly?
Absolutely.
Correct.
I think partnerships, et cetera, a need to help overcome those technological
So
challenges.
we could see reform if we're not careful in Congress that creates further consolidation.
That is a concern. I think there could be unintended consequences. That's why our proposal, the 10 recommendations, we thought was a little bit more comprehensive. If you take a rifle shot approach at this, we are concerned about unintended consequences.
Thank you, Mr. Kelly. Mr. Harrison, how will a proposal to increase deposit insurance limits for business accounts help smaller community banks compete with big Wall Street banks?
It really levels the playing field, Senator. Thank you for the question. And that's all we're asking for, is being able to compete on a level playing field. When we saw some of those deposits leave after Silicon Valley, not only did they not come back, but then that introduced the larger banks into our customer base. And so you're fighting just to hold on to the customers you had and have serviced for many, many years. So by the higher deposit limit, knowing their operating account is safe, that you'd be able to protect that and prevent that from happening next time.
Thank you very much. I think it's so important for us to get this right and to remain focused on getting this done, but getting it done right so that we don't worsen the problem. I'm going to stop now just to say that I beat Angela Albrook's record.
Thank you, Senator Warnock, for doing so. In closing, I'd like to thank the witnesses for being with us today. Some of you traveled across the country to be a participant in this hearing. Really helpful information provided to us today. I think that this committee should act, frankly, on increasing the limits. I think that it's not simply the payroll accounts that need to be taken care of or looked after. I think it's the average everyday American who may have saved all their lives and then put their money in an account and have too little insurance to be comfortable. I think if we think about it from that perspective, Mr. Rice, that you did a really good job. There's no such thing as a small business. As a former small business owner, it was big business for me.
Thank you, sir.
And so it's that sentiment that helps me appreciate that you understand not only what you're talking about, but who we're talking for. And that, for me, is as important as what we're talking about. For senators who wish to submit questions for the record, those questions are due 1 week from today, Wednesday, September the 17th. To our witnesses, you will have 45 days from that day to submit your responses to questions for the record. Thank you very much for educating and informing not only those of us on the Banking Committee, but those who are paying attention to this on C-SPAN.